Good afternoon, Gene Inger. Just a quick audio-video comment here. I'll be back, of course, on IngerLetter.com with both the daily briefing and the embedded MarketCast comments later on this evening. All of this is unfolding as we have indicated. Again, going back to this area in June, we pondered that though there was a liquidity crisis and credit crunch risk way back then, we pointed it out even before that, that we thought the market would drop down, rebound into July, making its top between the 6th and the 15th, maybe a few days later, dropping down, bouncing, plunging, then rallying to the vicinity of Labor Day. Subsequently, we've indicated it might not last that long because a lot of people are expecting now that they finally figured out. Obviously, we had the edge by anticipating even the Fed's discount rate cut, which we thought was the ideal way to save the system rather than bail out the circumventors of the system who were opposing the Fed and then begging for help subsequently and still are. And at the same time, we feel that a Fed funds cut would be sort of pushing on a string, i.e. you'd get a rally out of it. And people would say, oh, the Fed's changed their policy. That's nonsense. The Fed never had a truly restrictive monetary policy. They simply moved away from the free money scenario and brought rates up to normal. Rates never got above the 5 to 6% area, except in the mortgage market, which is not the same as a Fed-directed scenario. And indeed, therefore, as you know our views on this, but if you're an IngerLetter.com member, of course, and definitely we've expected this rally up and then a failure and some front-running ahead of Labor Day to take this down, and we indicated clearly in recent days, particularly yesterday, that we thought, and that was before we had no idea that Merrill Lynch was going to come out and do the downgrade today, but we again reiterated our own warnings about financials, home builders, retail, and said that anybody suggesting otherwise is not, would never say idiot about anybody, but we would say premature, and the light they see at the end of the tunnel because people are negative is essentially an oncoming freight train and they're about to get run over. Well, they got run over today already. And indeed, our point is that in a bull market, the bulls are right. In a bear market, the bears are right. It's at the transition points that the edge is so important. In any event, this S&P behavior has had us mostly short. Our forecast for today to our intraday members was down, up, down, or down, sideways, down. And we indicated during the course of the day and went back, even though we had a little long in here, we went back to the short side by intention above this 1452 area, so believing that the market would implode and indicating all day that we were down enough that we would probably see a 200-point down day, though it's impossible to know if there's any intraday squaring at the end, though in this case, there probably is not much because what they're going to do is look for more weakness in Asia and then continuing into Europe. And this is also nonsense when you hear people saying this is not an American economy anymore, it's a world economy, and therefore these American stocks that everybody thinks are vulnerable are not because they all operate overseas. Of course they do, but there is a connection, and already you can see in Germany, in England, and probably in China too, you're going to see certain aspects of slowing and contraction, and indeed, because they are so interrelated, again, we do not go down in isolation. This is why we've had such an opposition to this lunacy about integrating globalism to the extent that we have. Currently, the Dow is off 265 points. We are short the S&P, and you know what we're expecting in terms of the downside, and it is significant. And you know the pattern expectation, not only that we had correctly in recent weeks and months, but also the expectation we have going forward. There is no change in that. Currently, the Dow down 269, the transports down 128, the NASDAQ 58, the NDX 45, the dollar up 0.01, and the bonds finished up 10 ticks today. Meanwhile, we won't look at many individual stocks, but we warned about Merrill Lynch down 282, JP Morgan down 133, Las Vegas Sands perking up a bit in a bit of a turnaround. We are not enthused about the Macau commitment at this time because of our feeling about the Asian economy as well. We've got Hewlett down 79 cents, Cisco down 63 cents today. Best Buy down 60 cents. Amazon down 2.26. We've been warning about most, if not all of these. And Apple, too, down $5 and 46 cents in today's trade. Enjoy the evening. We'll be back at IngerLetter.com with the final later. Cheers.